Two people turn 22 on the same day. Same city. Same salary. Same late-night thoughts about the future. One of them buys a small apartment. The other buys a few shares of companies they barely understand. 30 years later, one owns a building they can touch. The other owns a portfolio they can't see. And somehow, the one who can't see it might be richer. Or not. That's the uncomfortable part. Because in your 20s, choosing between real estate and stocks doesn't just change your money. It changes your entire life. Right now, this choice matters more than it used to. Prices are rising faster than salaries. Rent feels like a leak you can't fix. Social media tells you two completely different stories. One side says, buy property as early as possible. They're not making more land. The other says, put everything into stocks. Let compound interest do the work. Both sound convincing. Both have truth in them. And both quietly hide what actually happens over time. Let's follow those two people. Same starting point. Different decisions. And watch what their lives become. At 22, the first one, let's call him Hassan, decides to buy real estate. He doesn't have enough cash. So he does what most people do. He takes a loan. Suddenly, Hassan isn't just an investor. He's leveraged. He puts down maybe 20%. The bank covers the rest. It feels powerful. With a small amount of money, he controls a much bigger asset. That's the magic of real estate. But it comes with a quiet trade. He now owes money every single month. No matter what happens. The second person, let's call her Sarah, chooses stocks. No bank. No loan. No property papers. Just an app. She invests a portion of her income every month. It feels underwhelming. No keys. No physical asset. Nothing to show her parents. Just numbers on a screen. Year 1 is uneventful. Hassan pays installments. Sarah watches markets move up and down. Nothing dramatic. But underneath, something has already started. Hassan's debt is slowly shrinking. Sarah's investments are slowly compounding. Two different forces. Both invisible at first. By year 5, things begin to feel different. Hassan's property has increased in value. Not massively, but enough to make him feel smart. He tells people he owns real estate. Technically true. Mostly. The bank still owns a big part of it. But the market doesn't remind him of that. It only shows rising prices. Sarah's portfolio has grown too. But it doesn't feel as satisfying. Because it didn't happen in a straight line. Some months were great. Others felt like losses. She's made money. But emotionally, it feels uncertain. This is the first big difference. Real estate feels stable. Stocks feel chaotic. Even when the numbers say otherwise. Now fast forward to year 10. This is where paths begin to diverge in a meaningful way. Hassan's property is worth significantly more. Let's say it doubled. Sounds incredible. But remember, he used leverage. His actual return isn't just based on his initial cash. It's amplified. This is where real estate becomes seductive. A small investment, controlling a large asset, growing over time. But there's a hidden cost. Maintenance. Repairs. Vacancy periods. Property taxes. Things that don't show up in Instagram posts. Meanwhile, Sarah has been doing something very boring. She kept investing. Every month. No matter what the market did. Up. Down. Sideways. She didn't try to time it. She didn't panic sell. She just stayed consistent. And now something strange happens. Her portfolio starts growing faster than her contributions. Not because she added more money, but because her money is now earning money. And that money is earning more money. This is the moment compound interest stops being a concept and starts becoming reality. By year 15, the emotional gap becomes obvious. Hassan feels secure. He has a physical asset, something he can rent out, something people respect. In many cultures, property equals success. There's a social validation to it. Sarah, on the other hand, still gets questions. Stocks. Isn't that risky? Isn't that like gambling? Even now, even after years of growth, her wealth feels invisible. And that invisibility creates doubt. But the math doesn't care about feelings. Let's look at what's actually happening underneath. Hassan's return is driven by 3 things. Price appreciation, rental income, and leverage. Sarah's return is driven by one thing. Compounding. But that one thing is relentless. Here's the uncomfortable part most people ignore. Real estate grows, but usually at a slower rate than stocks over long periods. Historically, property might grow around 3 to 6% annually in many markets. Stocks, especially broad markets, often average around 7 to 10% over decades. That gap sounds small, until you stretch it over 30 years. Because compounding doesn't grow linearly. It explodes. By year 20, the difference becomes harder to ignore. Ehsan's property is worth a lot. He may have even bought a second one. He has rental income. But his growth is still tied to physical limits. Each new property requires more capital, more loans, more management. It scales but slowly. Sarah's portfolio doesn't have those limits. She doesn't need permission to invest more. She doesn't need tenants. She doesn't fix broken pipes at midnight. Her growth is tied to markets, which are volatile, but also incredibly scalable. Then comes year 25, and life throws something unexpected. It always does. Ehsan faces a downturn in the property market. Prices stall, maybe even drop, but his loan payments don't. They never do. Leverage works both ways. It amplifies gains and losses. Sarah also sees a market crash. Her portfolio drops sharply. For a moment, it looks worse than Ehsan's situation. But there's a key difference. She isn't forced to sell. No bank is calling her. No fixed payment is hanging over her head. She can wait. And waiting is often the most powerful advantage in investing. By year 30, the story reaches its quiet conclusion. Ehsan owns valuable real estate, fully or mostly paid off. He has assets that generate income. He feels stable, grounded, tangible. Sarah has something different, a portfolio that has compounded for decades. It might be larger than Ehsan's net worth, or it might not be, because outcomes depend on behavior, not just strategy. And that's the part most people miss. This isn't just about real estate versus stocks. It's about how each path shapes your behavior. Real estate forces discipline. You must pay your loan every month. No excuses. Stocks require self-discipline. No one forces you to invest or to hold. You can quit anytime, and many people do. Real estate feels safer because it's slower, because it's visible, because it doesn't update its price every second. Stocks feel riskier because they're transparent, because they move constantly, because you can see losses instantly, even if they're temporary. But risk isn't just about volatility. It's about what can break you. Ehsan's risk is concentrated. 1 or 2 properties, 1 market, 1 location. Sarah's risk is spread across companies, countries, industries, different kinds of uncertainty. And then there's liquidity. Ehsan can't sell 1 bedroom of his apartment if he needs cash. Sarah can sell a small portion of her portfolio in seconds. Flexibility versus stability. So who made the better decision? The one with property or the one with stocks? The answer is frustrating because it depends on things no one talks about. Your temperament, your consistency, your ability to handle uncertainty, your patience when things go wrong. In your 20s, you're not just choosing an investment. You're choosing a system that will shape your habits, your stress levels, your opportunities, even your identity. Because one day, you'll wake up at 40 or 50 and realize you didn't just invest money. You invested your time, your attention, your decisions into one path. And switching paths later is never as easy as it sounds. So the real question isn't, which one makes more money? It's something much quieter, much harder to answer. Which system will you actually stick with when it stops feeling easy?